Growth investing can be a great way to achieve healthy returns in your investment portfolio. It's common to hear varied opinions on one strategy or another, whether it's dividend investing, growth investing, or something else. All strategies are geared to accomplish one goal, and that's to make money. While each have their pros and cons, deciding which one would better suit your lifestyle is a factor that's often overlooked. It's important to know the differences so you can choose which one will best suit your comfort level. You don't want to end up choosing a strategy that doesn't align with your goals. Consider the amount of risk that you'd be comfortable with. On the other hand, you want to increase the likelihood of your portfolio experiencing enough growth to fund your future without major sacrifices. It's not necessary to choose only one strategy, but it's a good idea to know the differences. This video highlights some points to consider when weighing being a growth investor versus taking a more conservative approach. My name is Chris, and I'm here to teach people about money, personal finance, and investing. If you're interested in improving your financial future, make sure to subscribe to the channel and hit the like button if this video is helpful. Growth investing is a strategy focused on capital appreciation. This means purchasing an investment at a low price and earning money from the rising share price. Those who follow this style invest in companies that exhibit signs of average or above average growth, even if the share price seems expensive when using traditional valuation metrics such as price to earnings and price to book ratios. The same type of investing is done with real estate. Someone might purchase a rental property simply for the fact that they think the value is going to increase substantially, even though it might provide little to no cash flow. This type of investing is the opposite of value investing, which is a strategy that Warren Buffett has used over the 80-year stretch, which has allowed him to achieve a net worth of around $90 billion. While some people might be quick to follow in the path of a great investor as such, growth investing has the same unlimited potential. The answer as to which would be better for your situation can usually be found by taking a look at your goals. Fast-growing companies often provide handsome returns for their shareholders. In the S&P 500, big growth names include Amazon, Facebook, Apple, and Google, which are relatively new companies. Each of these names have performed extraordinarily well when compared to the overall market. Google's stock price has quadrupled over the past 5 years. The reason for this is that not even that long ago, these companies were very small, so their potential was nearly limitless. Compare these stocks to those such as Procter & Gamble, Johnson & Johnson, and Bank of America, which have been around for a much longer time. Over the past 5 years, Procter & Gamble's stock price has only risen about 38%. Their growth has slowed, leaving smaller returns for their shareholders, even though people like Buffett allocate a large percentage of their portfolio to these types of companies. As with any investment, higher returns tend to come with higher risk. However, this risk can be mitigated by investing in more stable growth stocks that can be found in the S&P 500 and holding them for the long term. This is because there are certain guidelines companies must meet in order to be considered for the S&P 500. The requirements are that each holding must be a U.S. company, and it must be a large-cap company with a value of $5.3 billion or more. The company must have consistent positive earnings reports, specifically the past 4 quarters, and it must be trading at a reasonable share price, meaning the stock isn't way overvalued. A great option for hands-off investors is to purchase a growth stock fund, which holds only companies held within the S&P 500. This way, you're profiting from the fast-growing businesses with minimal risk. It wouldn't be smart to purchase stocks of very small, unproven companies and hope that their share price will rise dramatically. These large-cap companies that are held within the S&P 500 are more mature and stable, while still leaving room for upward potential. Growth stocks are more volatile than value and dividend alternatives. When the market fluctuates and takes a nosedive, these stocks get hit the hardest. This is mostly because investors seek income, investments that pay dividends, because they can rely on this consistent income for the most part. Even though dividends aren't guaranteed, they are pretty reliable. It's hard to determine when the market will recover or when the growth stocks will recover, but that's usually not a problem for dividend investors as they enjoy the same regular income, as long as the companies don't slash their payments. Also, when economic growth slows, it's unlikely that these growth stocks are going to continue to prosper like they once were, at least until things accelerate again. However, These more dramatic price fluctuations provide more opportunity to purchase on sale when the market is underperforming. And when dollar cost averaging over the long term, these more pronounced dips really make no difference. Growth stocks don't very often pay dividends, and if they do, they're usually pretty small. If you purchase an S&P 500 growth stock fund, such as Vanguard's VUG, the dividend yield will be around 1%. Apple's dividend is around 1%, which is higher than Amazon, Facebook, and Google, which have yet to pay anything to shareholders. The reason for this is that the board of directors has determined that it would be a better use of capital to reinvest profit within the business for further growth, as opposed to paying it out in the form of dividends. Retirees who have planned to retire on their dividend payments will probably not be using a growth investing strategy, unless a 1% yield would be enough to fund their expenses. If this were the case, they would need a much larger sum of money than a dividend investor who has a portfolio yielding 4% or more. A $4 million portfolio invested in a growth stock fund would only provide about $40,000 per year in dividend income. Dave Ramsey is known for claiming that 12% returns from the stock market are achievable for anyone. This belief has been controversial, as many people say that those returns are unrealistic considering the average rate of return for the S&P 500 is around 10% per year. It's widely known that Dave Ramsey is quite possibly the most conservative investor of all time. It wouldn't suggest anything that carries substantial risk. He recommends that you should never take out a mortgage for a rental property, yet still suggests that investors purchase growth funds. This is probably because the majority of growth funds that are available only hold large, stable growth stocks, which are really only volatile when compared to dividend alternatives. When purchasing these fast-growing companies, you're able to take part in growth that is often higher than the S&P 500 as a whole, while still owning companies with solid fundamentals. Luckily, if you don't have a strong preference regarding dividend or growth investing, there's no need to choose between one or the other. A healthy and well-balanced portfolio could consist of some high dividend investments to provide stability and income, which would complement growth stocks that will provide more exposure to fast-growing investments. Typically, investors choose to diversify and apply both methods to their portfolio's stock and fund selection. It's worth considering the current market cycle when deciding the best place to put additional funds. Growth stocks tend to perform well during bull markets or when the economy is growing, but do very poorly during bear markets when the economy is doing poorly. Both types perform well depending on the market cycle and timeline. However, growth investing does provide higher returns over the long term. If you invest $100 per month for 30 years and earn a 12% return, that will amount to about $324,000. If that same $100 per month only earns a 10% return, the end sum will be approximately $217,000. As you can see, slight differences in rates of returns can make a significant difference over time. When purchasing index funds or ETFs, there really isn't that much of a difference at the end of the day. Sure, historical returns are usually a little better with growth investing, but the market generally moves together. In other words, investments more often than not follow similar patterns and provide comparable returns over long periods of time. If you're young and have many years before you'll need to take disbursements from your investments, growth investing is probably the better bet, as the slightly higher risk will provide slightly better returns. For older investors who will be needing income sooner rather than later, are trying to minimize any risk and aren't overly concerned with capital appreciation, a dividend or value approach might better suit their needs. Of course, each strategy has its pros and cons. If you're seeking higher returns, you might lean towards growth investing. Higher income can be found when purchasing an S&P 500 dividend fund or something similar. If you'd rather stay neutral and not lean one way or another, a total stock market fund or a general S&P 500 fund are great choices. It's nice to be aware of the options that are available and the benefits they provide. At the end of the day, the reason for a lack of funds at retirement age isn't due to the poor rates of return, but the lack of investing altogether. The most important thing is to make sure you're investing consistently. This will allow your money to compound sooner, regardless of whether or not you could be earning an extra 1% per year.